SoFi beating on the top and bottom lines, raising full-year guidance. Joining us right now, first on CNBC, is SoFi CEO Anthony Noto. It's great to see you. I don't know if we've actually had the opportunity to talk in quite a while, but let's talk about these earnings. Let's talk about how you see this economy and what it means for your business.
Yeah, we're really excited about the quarter. 2025 is off to a tremendous start. We grew revenue 33% year over year. That's an acceleration. It's our fastest growth in 5 quarters to $771 million. It's really driven by great product innovation, strong branding, leading to member growth of 34% year over year. It was the largest quarter we had in member ads at 800,000 and a 35% growth in products. So our cross-buy is really working at 32% of the products coming from cross-buy. Really strong profitability. Our EBITDA was up 46% to $210 million, also a record, and earnings were very strong. We feel like we're incredibly well positioned competitively. We're stepping on the gas. We're going to accelerate our rate of innovation, launch more products sooner, re-enter the crypto category, and really making sure we're staying in front of everyone else in our leadership position. I love our competitive position and think right now with the environment we're in that we're seeing really strong demand from our members. We want to meet that demand.
Well, let's talk about the lending business and then let's talk about the crypto business because I think there's a lot of folks who are fascinated by both. Why don't we hit crypto first? Where are you in that journey at this point?
Well, the first thing I'd say is the regulatory environment is definitely evolving, and it's going to allow us to re-enter being able to offer crypto coins in our invest product, the ability to buy, sell, or hold cryptocurrency. And we hope to be able to do that over the next 6 months or so. In our earnings call, we'll talk about the fact that over the next 6 to 24 months, we want to enter cryptocurrency and blockchain activities in a much broader and more significant way. Again, it's dependent on the evolving regulatory environment, but so far that environment's been really positive. We want to be able to offer blockchain products and crypto products across every area that we're currently in. So across lending, across paying, across investing, and as well as protecting. We think it's a technology more than anything else, and we can use it to allow people to pay easier at lower cost, to pay faster, and over time be able to capture some of the opportunity by providing infrastructure services to third parties via our technology platform. So it really will cut across every element of our business.
What is the blockchain business and crypto business in the lending space ultimately look like to you?
Again, it's going to be subject to the regulatory environment, so I just have to caveat that. But today, we provide margin loans in our invest business where you can borrow money against your securities, against your assets. We could do the same thing with cryptocurrency. If we custody the cryptocurrency, we can provide a secured loan against that currency. Again, a lower cost of lending for our members, just like margin loans are, but an asset that they can borrow against, just as they do their home or securities in their invest account.
Right. So there's 2 things going on that I know some investors may have some confusion about. So there seems to be an effort at one level to move away from the sort of classic lending business to focus more on fee revenue. At the same time, there's been a huge growth in the lending or loan platform business. And so can you explain the distinction for those who are sort of trying to follow this company?
Sure. The first thing is to understand our mission. And our mission is to help people reach financial independence to realize their ambitions, which means they get to the point that they have enough money to live their dreams, their American dream, have the size family they want, the size home they want, the career they want, and live where they want and retire when they want. In order to do that, we have to be there for every one of their major financial decisions in their lives and the days in between, which mean we really have to be across everything they do: borrow, save, spend, invest, and protect. So we do have 4 great loans. We try to provide the fastest place to apply and the lowest interest rates. We have more demand for our loans than we can fulfill ourselves. So some portion we'll do ourselves and some portion we'll do on behalf of third party. So the loan platform business is really a fee-based business where we leverage our origination platform, our marketing platform, our servicing platform to underwrite loans for other people like Blue Owl and Fortress.
Well, that's what I was going to say. So you did this. Explain, though, because I don't know if everyone knows. You did this deal with Blue Owl, which is one of the big credit providers in the country, for worth about $5 billion, right? How does that work?
Yeah, the way it works is they contract with us for a specific type of credit they want underwritten. We go out and generate demand for that underlying loan. We then fulfill that loan, and they take the loan away from us within a couple of days. So it's very capital light. We don't retain any credit risk, and we don't retain any capital requirements. It's something that we're doing on their behalf that we would not otherwise do for ourselves, either because we don't want that level of volume or that credit box. We actually turned down in a year over $100 billion of loan volume. We only fulfill about $20 billion ourselves. So that over $100 billion of loan volume, other people would like to have. We focus on a high-end customer that's 680 and higher. average FICO score around 750, average income around $150,000. But there are many of other people that have the need to invest in assets at a lower credit spectrum, and we're helping them do that, in addition to some volume in our credit box that's above and beyond the volume we want to do. So it's a high margin revenue stream, it's fee-based, and it doesn't retain credit.
What are you seeing in terms of the strength of the consumer? And I ask because there was a piece, I think, in the Wall Street Journal just this week, right, about so many people using buy now, pay later and just putting more and more things on their credit card. You're starting to see a credit build. There's a Lending Tree survey finding Americans are using more of these services than ever before just for groceries and things, Anthony.
Sure. We're watching all the macroeconomic factors the way we would any other time of the cycle to make sure we have our early warning if there are problems. So far, we've not seen any issues with credit. In fact, our credit performance continues to improve. Our 90-day delinquencies improved again for the fifth quarter since last year in a row. We've also seen lower than expected net charge-offs and an improvement there as well. So the underlying credit's doing well, and the demand for loans are very strong. We're also seeing strong spending in our SoFi Money business. We're annualized at about $14 billion of debit spending now, and it's growing faster than our underlying member growth there, which is about 46% growth in our money product, and spending is growing even faster. Deposits are growing faster as well at 52%. And then in our invest business, where you can buy, sell single stocks or fractional shares, IPOs, alternative assets, we had our strongest engagement quarter ever, even stronger than when we launched crypto or IPOs or alternative assets. And so an acceleration in our member growth there, up 21%. And we expect that acceleration to continue throughout the rest of the year. So we guided the full year up in addition to beating. We also guided second quarter above consensus. We feel great about where the business is. We're looking for all the data points everyone else is talking about, but so far things have been pretty strong.
Anthony, do you think that's because it's a reflection of your members, a reflection of your clientele, or do you think that maybe some of those stories are being exaggerated about people needing to borrow to pay for the groceries?
I think it's a little bit of both. We definitely have a higher end customer, and the viewers should understand that. We're going after a high income customer, $150,000 income or higher, high credit, 680 or higher. So that's in our loan business. But our money business goes after everyone, and our invest business goes after everyone. So it is a reflection of the broader economy. I do think people are looking for reasons not to be bullish here because of the uncertainty. And believe me, I know how to be as bearish as anybody. And right now, we're not seeing the changes. What would scare me is if we had unemployment get up into the high 5 or 6% range. We're not anywhere close to that today. But in an environment where we have declining rates, we're going to do incredibly well. We're going to see a lot more home refinancing. We're going to see refinancing of student loans. And we're also going to see continued improvement in credit in that environment, as long as we don't go into a deep recession or have some type of liquidity dislocation. A deep recession, liquidity dislocation would be really bad. But right now, it seems like things are being managed pretty well.
So today, SoFi gapped higher on the daily chart, but ended on the lows of the day at $13.27. And that was good for an increase on the day of 7 cents relative to Monday's price, or 0.5%. Now, if we scroll out to the monthly chart, we have this big support resistance band at $10, which is also a round hole psychological number. And scrolling down to the weekly chart, prior to the equity market crash that we saw over the last couple of weeks, I was anticipating price bouncing off of this resistance support band at $10. But price went lower and found unfilled buy orders and buyers willing to buy price at a huge discount relative to where price was, which was double the price back in January, at this daily buy level at $8.50. And if we zoom back down to the daily chart, just want to show you how that was formed. You had this rally in price, a couple of basing candles, you had a rally out, and then you had a gap higher. So huge imbalance between buyers and sellers. Also, this rally out takes out some pivot highs to the left. And so rightfully so, when price comes back, and this is what you want to see. You want to see a screaming crash into the zone. That screaming crash indicates that on the way back, there's really no sellers at any levels. Nevertheless, on the way down, price opened, dipped its toes in the zone, and then shot higher. Now, price is above the key 200-day moving average. Typically, anything above it, you're in a secular bull market. Anything below it, you're in a secular bear market. So let's highlight these basic candles here and go out to the weekly chart. Now, if we can get another strong move higher, meaning another extended range green candle to say end the week, then this is a rally, basic candle, and then the rally out, potentially creating a weekly buy level. Watch out for this level here. This is a drop, base drop, and so that becomes, at the moment, a level where sellers, as you can see, push price back down again to end on the lows of the day. However, this zone is in the middle between huge imbalance of buyers and sellers, and so I would anticipate momentum is to the upside. Yes, you got a reaction, but now I'm anticipating the sellers losing out to the buyers, price pushing up higher, targeting again the recent local highs. Again, we get a candle close above this sell level. This becomes a valid buy level if price was to return. Ultimately, medium-term target, again scrolling out to the monthly chart, is 18, but $20, which is below all these rejection wicks.